Warren Buffett, one of the richest men in the world, a living legend in the world of investing, a man who's been buying and selling stocks for over 70 years, with such precision that millions on Wall Street can only watch and envy. But there's something most people don't dare to say. Even he makes mistakes. Big ones. IBM, Tesco, Kraft Heinz. These aren't some forgotten startups. These are billion-dollar giants, and each one left a scar on Buffett's portfolio. So here's the big question. If the world's most seasoned investor can still make colossal mistakes, what chance do we have? The ones still learning, still building our own path. Or maybe, just maybe, it's these very mistakes that hold the greatest lessons. Lessons about how a true investor thinks, not just when they win, but especially when they lose. In this video, I'll show you 3 iconic investing mistakes from Warren Buffett's career. But I'm not just throwing numbers at you. I'll dig into the real takeaways, the thinking behind the decisions, the warning signs he may have missed, and most importantly, how you and I can avoid falling into the same traps. So, are you ready? Because what you're about to see isn't a fairy tale. This is real, with billions on the line. Why is it important to talk about Buffett's mistakes? When you hear the name Warren Buffett, most people instantly think Coca-Cola, Apple, Geico, an American icon, a man who's outperformed the market again and again over decades, someone who's generated billions not just for himself, but for his shareholders too. And yet, there's something we don't talk about enough. What happens when the world's greatest investor gets it wrong? When he misreads a trend or holds on to a loser too long? These moments say just as much, if not more, about who he is than his successes. Because in these situations, we see his true strategic depth. How does he handle failure? Does he admit it? Learn from it? Or double down until the very end? And that's the key. This video isn't about tearing Buffett down. We're not here to destroy the myth. It's the opposite. We want to see beyond it. To understand that even someone whose touch has turned to gold for decades can still make very human mistakes. Because let's be honest, we, everyday investors, mess up too. We buy bad stocks, hold on too long, misjudge a trend. And then that inner voice kicks in. Why didn't I see this coming? Maybe I'm just not cut out for this. But if Buffett has lost tens of billions and still comes out wiser, maybe we can give ourselves permission to learn too. So this video is a chance, not just to talk about investing, but about thinking, about decision-making, about human error, about what it really means to learn from your losses, and why sometimes those losses bring you closer to becoming smart money yourself. Failure number 1, IBM, the tech miscalculation. 2011, Wall Street was stunned. Warren Buffett, the same investor who had famously avoided tech stocks for decades, suddenly announced he had bought over $10 billion worth of IBM shares. The reasoning? Simple, elegant, and in hindsight, painfully naive. IBM wasn't just a tech company. It was a fortress, a decades-old institution with deep roots in government, banking, and global enterprise, recurring revenue, massive B2B contracts. A dinosaur, yes, but the kind that survives. At the time, Buffett said, "I don't need to understand the cloud or programming. I just need to understand the business model." And that one sentence said everything about why he got it wrong. While Buffett was focused on IBM's past dominance, the world was busy redrawing the tech map. Amazon Web Services quietly revolutionized data infrastructure. Microsoft Azure seamlessly embedded itself in enterprise ecosystems. Google Cloud sprinted ahead in AI and scalability. Meanwhile, IBM, stable on paper, was losing momentum fast. Growth stalled. Innovation slowed. And the management? More focused on slide decks than real solutions. The biggest red flag? The market no longer saw IBM as a tech leader, but as a slow-moving bureaucratic relic. Buffett held the position for more than 6 years. He didn't sell when the first cracks appeared. Not when competitors started to dominate. Not even when it became obvious IBM had lost the future. The stock price barely moved. Meanwhile, Amazon, Microsoft, and Google were adding hundreds of billions to their valuations. Buffett finally exited most of his position in 2017, with a sizable loss, but an even bigger missed gain. Lesson, the positive side. But before we judge too harshly, let's look at the brighter side. This was Buffett's first real move into the tech sector. A conservative, fundamentals-based investor in his 70s, willing to question his own rules. That alone is admirable. His decision wasn't based on blind optimism. It was backed by IBM's strong cash flow, high client retention, and the belief that it could adapt to a modern marketplace. Buffett saw value in a complex world. And that's bold, even if it didn't pay off. Lesson, the negative side. But the root of the failure runs deeper. Buffett didn't grasp the real tempo of tech evolution. He didn't see that technology isn't just a sector, it's a mindset. While Amazon and Google were innovating at full speed, IBM was playing defense. Too slow, too conservative, unable to capture the imagination, or the markets, of a new generation. The biggest lesson? Past success doesn't guarantee future dominance. And the most dangerous assumption an investor can make is this: this company is too big to fail. This isn't just a story of a bad investment. It's a story of what happens when you fail to adapt. Because in markets, it doesn't matter how strong your legacy is. If you can't evolve, the market will bury you without hesitation. Failure number 2, Tesco, the British supermarket trap. Tesco, an iconic name in British retail. At one point, it was so dominant that 1 out of every 10 pounds spent in the UK went into a Tesco till. And Buffett, the master of stable, cash flow-driven businesses, saw exactly what he wanted: a reliable, well-known brand, low valuation, strong market position, long-term potential, everything a value investor looks for. Around 2006, Buffett started buying shares, and he didn't go small. We're talking hundreds of millions of dollars. On paper, it looked like another classic Buffett play. Buy undervalued, hold patiently, collect dividends, watch the value rise. Simple. But as always, the reality was far more complex. While Buffett crunched the numbers, Tesco was cracking from the inside. It started with overly ambitious international expansion. They pushed into the US market with the Fresh and Easy chain, and it was a total disaster. American consumers didn't understand the concept. Stores remained empty, and while things weren't going well at home either, Tesco continued spending billions overseas. Then came the domestic issues. The UK grocery market was shifting faster than Tesco could react. Aldi and Lidl showed up with low prices, lean operations, and simple product lines. The discount chains flipped the entire industry on its head. Suddenly, Tesco, once a symbol of reliability, started looking overpriced, outdated, and slow. And as if all that wasn't enough, in 2014 a major accounting scandal broke. It turned out Tesco had overstated its profits. By hundreds of millions of pounds, the stock crashed. Leadership was ousted. Investor trust evaporated overnight. And Buffett? After years of awkward silence, he sold, at a massive loss. And all he said was, "It was a mistake. We made a bad decision." That kind of self-criticism from Buffett is rare. Almost dramatic. A quiet admission that this story had been broken for a long time, and he'd waited too long to face it. Lesson: the positive side. Still, let's give credit where it's due. Buffett did get out. He didn't double down. He didn't try to spin it. He didn't blame the market. He closed the chapter. And by doing so, he cut off further losses and preserved liquidity for better opportunities. That's a powerful lesson. Sometimes the most professional move is knowing when to stop fighting for a losing position. Pride is not a strategy, but cutting losses, that can be. Lesson: the negative side. But here's the deeper, more uncomfortable truth. Buffett believed in the model for too long. He believed in Tesco's legacy and failed to see that the world and its consumers had moved on. The accounting scandal was just the tip of the iceberg. The real problem began when Tesco's competitive edge eroded, and Buffett refused to see it. This is a classic value investor blind spot. When you're so focused on fundamentals, you ignore the world that's changing right in front of you. So Tesco wasn't just a bad investment. It's a reminder that the glory of the past won't save you from the mistakes of the future. And that sometimes the hardest, yet most necessary move, is admitting you were wrong and walking away. If you're happy with the quality of the video and feel like supporting my small channel with a like or a subscription to help me reach my first 100 subscribers, I'd be incredibly grateful. Thank you so much. Failure number 3, Kraft Heinz, the brand that couldn't grow. This third story isn't Buffett's biggest financial loss, but it's undoubtedly his most embarrassing, because this wasn't just a stock position. It was one of Buffett's most high-profile strategic moves, one that he himself once cited as a long-term example of investing excellence, and one that ultimately collapsed in spectacular fashion. Between 2013 and 2015, Buffett, together with the Brazilian private equity firm 3G Capital, engineered one of the largest mergers in food industry history, the combination of Kraft and Heinz. The goal? On paper, brilliant. Create massive economies of scale, cut costs, and fully exploit the global recognition of two iconic brands. The newly formed Kraft Heinz instantly became a powerhouse in the American food sector. Buffett even went as far as saying, "This is the kind of business I want to own even after I'm gone." This wasn't a trade. It was commitment. But while the financial models forecasted growing profits, the world was already changing. Radically, consumers were turning away from processed and preserved foods. Grandma's recipe wasn't good enough anymore. Fresh, organic, local products, plant-based alternatives, clean label products. These were the new normal. But Kraft Heinz remained stuck in the past. Yes, their brands, Kraft cheese, Heinz ketchup, Lunchables, were familiar, but they were no longer desirable. Not trendy, not relevant. And 3G Capital's trademark cost-cutting approach only made things worse. Layoffs, reduced marketing, axed innovation projects. Instead of competing for the future, they optimized the past. The result? Catastrophic. In 2019, Kraft Heinz announced a $15 billion goodwill write-down, essentially admitting that their brands weren't worth what they had paid for them. The stock crashed by more than 25% in a single day. Buffett publicly admitted, "We overpaid, and we underestimated how fast the industry was changing." This wasn't just a financial failure. It was a strategic one. A clear example of how even the sharpest minds can fool themselves if they believe too strongly in a model and not enough in the world outside that model. Lesson: the positive side. To be fair, the Kraft Heinz deal was built on a rational, clear principle. Buffett always believed that scale, simplicity, and brand recognition gave companies long-term competitive advantages, and in theory, it made sense. Heinz was a century-old name. Kraft products were in every American fridge. On paper, the merger looked perfect. And he wasn't going at it alone. 3G Capital was a proven, aggressive partner with a track record of increasing operational efficiency across industries. That trust, that belief in partnership, was the engine of the deal. It also showed something else. Buffett was willing to collaborate with investors who operated very differently than he did, and shift from passive investing toward more active portfolio management. Lesson: the negative side. But now comes the black box. What really went wrong? The short answer: they didn't listen to the consumer. The long answer: strategic arrogance, technological and cultural blindness, and overconfidence in legacy. Kraft Heinz failed to innovate. It didn't evolve with consumer preferences. It didn't respond to the rise of Whole Foods, Impossible Foods, or Beyond Meat. No new startup partnerships. No experiments. No real reinvention. Just waiting until its brands started collecting dust on the shelves. And the biggest takeaway? A brand isn't powerful because it's widely recognized. It's powerful because people still choose it. Recognition is not the same as demand. And just because a company makes a profit today doesn't mean it'll still exist 5 years from now. The fall of Kraft Heinz is a flashing warning light, a dramatic reminder that the world waits for no one, not even Warren Buffett, and that a real investor doesn't just ask, "How much can I earn from this company?" They ask, "Will people still want this 10 years from now?" Conclusion: what do these failures have in common? 3 companies, 3 completely different industries, 3 different decades, a tech titan, a retail empire, a food industry classic, and yet, something invisible connects them all. Something subtle, but fatal. It's belief. Belief in a worldview that no longer exists. In each case, Buffett invested in companies that had once been incredibly successful. And that past success blurred the importance of the most crucial question any investor must ask. What's happening now? And more importantly, what's coming next? With IBM, it was faith and stability that masked the pace of a tech revolution. With Tesco, it was belief in past dominance that hid the shift in consumer behavior and rising competition. And with Kraft Heinz, it was overconfidence in brand power and scale, right when the world was demanding freshness, adaptability, and human connection. But the real shared thread? In each case, the past became the master, instead of the advisor. The past should inform your decisions, but it should never dictate them. If you base your investments only on what a company did 20 years ago, you might miss what's happening right now. And worse, you might be completely blind to what happens next. And there's one more thing that ties these stories together, something deeper. And maybe, the most important of all, Buffett didn't deny his mistakes. He didn't hide. He didn't over-explain. He didn't shift the blame. He owned them, fully, openly, and honestly. And then he moved on. That's what separates average investors from great ones. The ability to learn, even when it costs millions or billions. The courage to admit when you were wrong. And the humility to adapt. Most people think success means always making the right move. But the truth is, even the best make bad calls. The real difference is how they handle it. and what they learned from it. Now that you've seen how even the most legendary investor in the world can make massive mistakes, let me ask you, honestly, what's been your worst investment decision so far? Was it buying crypto at the peak? Holding a stock for too long? Or maybe waiting too long and missing out on a big opportunity? Drop it in the comments. Let's learn from each other's mistakes. Because as Buffett's story shows, losses aren't a shame.
If you learn from them, they become tools.
And if you feel like this video helped you think differently about your investments or gave you a fresh perspective on financial decision-making, then hit that subscribe button and join a community of people who don't just want to make money, they want to think smart about it. Subscribe now, don't miss out. And tell me in the comments, which mistake taught you the most about becoming a better investor? Thanks for watching. I'll see you in the next one.